more on these CPI numbers and what they mean for the rest of us. We're joined by somebody I consider an expert on this field, Thomas Hayes, our friend and founder, chairman and managing member of the Great Hill Capital. Good to see you, my friend. These numbers, look, I think they're controversial. I actually don't think the CPI numbers are that big. I think the jobs numbers are much bigger. Correct me if I'm wrong. These numbers came in within expectations. The markets had expected a lot, and I guess they ended the day up. Is the markets right?
That's right, Phil. Thanks for having me. They were largely in line with expectations, but the silver linings were having that negative month-on-month print for headline inflation. And the other thing that we're talking about a lot on Wall Street today is the 3-month annualized rate. If you take the last 3 months of core inflation and annualize it, it's 2.2%, which is below the Fed's target for core inflation. If you annualize headline inflation, that takes headline inflation to 0% annualized if you average the last 3 months. And finally, services ex rent, if you annualize, is around 1%. So that's why the market was up. It was a little volatile in the morning until people worked that out and understood that. To your point, jobs are still pretty hot, a little hotter than expected, but they're coming down consistently over time, hot relative to expectations. I think the big story going into tomorrow, though, Phil, is expectations for earnings are extremely low. Negative 4.1% for Q4. But when you look at that in isolation, it's a little confusing because the Atlanta GDP now tracker, the Atlanta Fed tracks GDP, they're estimating Q4 GDP was plus 4.1%. Okay. So it's kind of hard to have negative earnings and positive GDP, and I think that's why we're going to have positive.
I'm going to call I'm going to call. I'm going to say this because you're our friend on the show, okay? So yeah. I'm going to question this because if the numbers are better and the earnings blow them out as you say they are, if I'm the Fed, my job is to squash your optimistic expectations, right? We want jobs to be weak. We want CPI to be weak. We don't want earnings to be good because those are all the things that the Fed was trying to calm down to begin with. Isn't that only going to make the Fed be more aggressive?
Yeah, the market doesn't believe the Fed anymore. So you saw the 2-year yield today at 4.14. That's below the current Fed funds rate. Never mind that everyone expects them to go another 25 or 50 basis points over the next meeting or two. The market is saying basically, look, they're not going to send you an invitation in the mail, Phil, and say, next meeting or 2 meetings from now, we're going to pause. Please start buying equities ahead of our rate.
They did say to expect that rates remain high for some time, and many people are saying all the way through the rest of this year. Let's just say they raise a quarter point, maybe another quarter point. Yeah. If I'm the Fed and you're calling my bluff, you think I'm lying, I'm going to make more of an effort to make sure you know I'm not lying. I mean, it just seems to me that the good news is still potentially bad news, but I guess maybe you think differently.
Phil, you absolutely nailed it. I do think they're going to keep rates elevated, but that doesn't mean stocks can't go up. I'll give you a perfect example. We had a tightening cycle in 1994. They tightened very, very quickly, and then they held it. And they not only held it from 1995 to basically 1999, everyone says tech can't go up because the Fed funds rate is going to be over 5%. You know what the Fed funds rate was from 1995 to 1999? It averaged 6.5%, and they held it up, and the stocks did exceptionally well because demand was there. Okay. And I think that's the surprise moving forward.
So that said, should we stop talking about inflation? Because we talk about inflation all the time, whether it's in Europe, in the U.S., or Asia. We're always talking about inflation, how it's bad, 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 and now we're seeing signs that they're starting to significantly calm down. And if it's basically 0%, if you look at the last couple of months, that's a huge, huge difference.
Yeah, and they're going to have to figure that out. And when they stop, like I said, it's going to be abrupt. You know, this happened in 1982. Volcker was saying, keep at it, keep at it, keep at it. Then miraculously, while inflation was still 7%, but coming down on October 5th, 1982, he said 3 magic words: may shift tactics. The stock market had corrected 27%. Within 4 months of him changing those 3 words, it recovered 100% of its losses and went on to make new highs the following year.
I give up. What sectors and what stocks are you buying? So you want to fight the Fed? Fine. Tell me the sectors you're buying and tell me the stocks you're buying.
Well, it's interesting. It's not about fighting the Fed. It's buying high quality that's been cut in half. So first and foremost, where do I want to be? I want to be in China. Okay, China has been increasing money supply, M2 money stock, by double digits for the last 6 months, while the U.S. money stock, with quantitative tightening and otherwise, has been contracting. So first and foremost, I want to take advantage of China, and I want to buy the highest quality business there, in my view, is Alibaba, because you get a third ownership of Alipay, with Ant Financial, which has Alipay. You get the cloud business, which is basically where AWS was in the U.S. in 2016. Oh, and by the way, you get a consumption business which the government has deemed is their priority in the next 12 to 24 months to recover growth. So number one, I want to be in emerging markets. Why? The dollar's come off 10% in the last 3 months. When the dollar goes down, emerging markets go up. It happened from 2002 to 2007, 480% rally. It happened from 2009 to 11, 2016 to 18, and 2020 to 2021, and it's happening right now. So that's where I want to be, number one. Number two, I want some tech exposure in the U.S., high-quality businesses that have been cut in half. Last time we talked about Amazon. No one wanted it. You couldn't give it away. Now people are bidding it up the last 2 weeks, and I think that's going to persist moving forward.
All right, you're going to help us pick some money. Thank you very much, Thomas Hayes. Good to see you. You're making the Chinese investors very happy. Thank you.